Hello, this is a brief presentation on our research paper, A Deep Learning Forecaster with Exogenous Variables for Day-Ahead LMP by Dipanguita Saha and Felipe Lopez from GE Digital. This research is motivated by decisions that power generators need to make on a daily basis. Power generators participate in the electricity market by producing the energy that is then transmitted to your house by the grid. And profitability for those power generators is linked to a concept called spark spread, which is the difference between the energy price and the production cost. Now, profitability is usually linked to spark spread because there are cases in which a generator may still be profitable even if the spark spread is negative. And that is when the losses that a generator would incur by producing below cost and less than the money that it would take to shut down the equipment and to start them over again. This turns profit optimization for power generators into an interesting risk management problem, in which if the generator were to beat production cost only, it may need to shut down often, and that would mean losing money. If, on the other hand, generators beat below cost, then it's possible that they may save some money, but only in certain cases. One way to assess power generators in this task is by reducing the uncertainty that they have when they make these decisions by providing them with better models to predict what the energy price is going to be. And in this particular market, we're focusing on day-ahead LMP, which is calculated with the aggregate of all of the bits that are submitted with power generators and when the ISO's demands of forecast. The approach that we followed is to have a single forecasting model that would incorporate various components into it. We were going to take into account a trend to capture low-frequency dynamics, such as the effect of shoulder mounts, fuel price. We were going to take into account seasonality to capture the effect of day of the week, time of the day. We were going to take into account the effect of residuals so that we can capture shocks that propagate over time, and also the effect of exogenous variables, such as temperatures and the effect of renewable energies. And in our approach, we favor neural networks as opposed to traditional time series techniques to capture the effect of nonlinearities. We divide our model into two parts. We were going to take into account both historical data and the effect of forecasted exogenous variables. And to do that, we proposed a deep learning model that has two blocks. It has a recurrent block that has a set of LSTMs that look into historical data and learn the effect of historical data, trend, and seasonality. And we have a separate block that takes into account exogenous variables. And we then merge the effect of both by stacking our networks in using a set of one-by-one convolutions. We benchmark our model with traditional time series techniques, such as AR models, Sarimax, and stateless neural networks that take into account only exogenous variables and ignore historical data. We observe that our model has improved performance on traditional statistical metrics, such as MSE and MAPE, and that our model also has improved performance at predicting the valleys in the price. Note that the valleys are going to be the most interesting parts of the plot because these are the parts that correspond to the decision of whether to bid below price to prevent incurring on shutdown and startup costs. Based on these observations, we conclude that sequential deep learning models with exogenous variables appear to be a promising approach to predict energy price for power generators. We notice that the use of exogenous variables helps us account for the effect of weather, energy demand, and renewable energies. And one thing to consider for the future is that this analysis may be extended to a full risk management problem if we allow our model to take uncertainty into account. If you want more information, come check out our paper. Thank you.